Hello, everyone. It was a pretty dull day overall for the market, but we did run into pretty decent resistance at the 50-day moving average, or near the 50-day moving average, as to say, on the Nasdaq and the Russell 2000. The Russell 2000 was down 0.74%, but it did not close below the low a day yesterday, 1143. So until it closed below, until we close below that low a day, we're not going to initiate any new short hedge. So no put contracts need to be bought following today's down session. No 3 times ETFs need to be purchased in the IRA or sold short in your margin accounts. Overall, it's a down day, but there's just not enough indication if it's bad or good. If anything, the Nasdaq, even though it's closing below its low a day, it therefore would make a shortable or a put buy position. However, volume was actually lower than the day before, showing that there wasn't a whole lot of sellers behind the move down today. So it's too early to say that they are going to fail here for certain. But we're at those levels that if we start to really roll over here and see volume pick up, we will add to our hedges. The New York Stock Exchange and S&P 500, similar situation. They were both barely down today. Volume was lower than the day before. This index is still above its 50-day moving average. The Dow Jones 30 continues to do fine. Nothing is wrong with it. And the Dow Jones 20 transportation average continues to be fine. We'll be looking for a reversal, though, because interesting action today in the utilities. The XLU reversed heavy off of its high. And lately, as it's been moving up, it's actually been getting some distribution on the way up. Broke out with some decent volume, but then heavier distribution shortly after, and fall through intraday reversal today. So we'll see how we react there. But overall, there is nothing to do. I have no new long positions. I have no new short positions. I have no sells. I have nothing to do. The most interesting thing I guess we could say today is that nothing happened, but I do want to make note. Netflix yesterday, I made mention in the chat room, which was a great response by my vice president. Then why don't you do it, idiot? And that's so true. But I made mention that if I was a hedge fund, I had a lot of money to operate, and I had to put something to work, which I don't feel like I need to put money to work right now. I feel like that we're in a chop zone. I would have shorted the gap up in Netflix. I think it was almost a no-brainer following the breakdown in March. That trade turned out to be quite prudent as we closed off the gap up yesterday, and we continue to sell off today. So from the 376 gap up, we're now at 353. Then let's look at SMCI. SMCI gapped up to 2191, closed at 1934. That's not bullish because that was a very strong earnings beat, had an excellent little go. On top of that, SWKS, which is still fine, it's managed to close higher than where it opened, so we'll continue to watch this. But as SWKS reverses its gap up, that'll be something to see because that also had very nice earnings and the chart looks solid. And I bring that up because Facebook is gapping up slightly tonight following its earnings beat. However, this is the weakest gap up Facebook has had following earnings since the stock IPO'd, which may be telling us that the excitement, the I gotta buy anything that's beating earnings is going bye-bye. Already you can see this chart is under a lot of distribution. There is a lot of almost churning action in the volume lately. So if we fade the gap up tomorrow, I don't see how that's going to be great for stocks in the short term, especially as we come up to the month of May. We're 1 week away from the month of May, and the axiom of sell in May and go away is historically the smartest thing to do. The past 230 years of data that we have on the stock market overall shows that the worst months for the market are during the summer. So if you want to fight 200 years of trends, go for it. I just don't. I like to put the odds in my favor. And then on that note, even more important tonight is Apple. Apple beat earnings tonight, is gapping up, and what are they doing? The thing that you see the most as stocks are ready to top, it split. Now, just to remind you, Google just recently split 2 for 1 because its share price is too expensive for mom and pop to get in. It's only good for the institutions. So now they need to suck in the gullible public. After 6 years of a bull market, after enough mention of the name Google, Priceline, Facebook, Apple, Twitter, you need to start bringing people in. So Google splits 2-for-1, brings their stock price down from 1,000 to 500. Apple currently is a $500 stock. You split 2-for-1, you bring it down to the 250s. This is stuff stocks do whenever you start splitting whenever you start to get too big. You know that you don't have huge growth coming up, so you start to split and increase dividends. Apple also increased its dividends, so now you got more of a dividend play. This signals to me that Apple is done. For now, the bull market of 2003 to 2012, and Apple is over. This is your confirmation signal as far as I'm concerned. Whenever a stock decides to split after going nowhere for 2 years to try to get investor attention, and that, like I said, just follow Google's. Now all I need to do is see Priceline, which is a $1,200 price stock split. If I get Priceline to split, along with these shitty IPOs that have no earnings that are coming to market, investor sentiment at 1987 lows for bears, 1990 highs for bulls, and a VIX down here at, where did the VIX close today? I would love to see the VIX actually down for the day, but it wasn't. It was actually slightly up at 13. This is just a market that's unbuyable for me, especially with the forward price earnings ratio of 17 on the S&P 500 and just a lot of stocks with price earnings ratios either not existing or over 100. I don't believe we're in a tech bubble again like 2000, but all the signs are on the wall of a market that's going to be having a very difficult time making more forward gains. So as volume dissipates going into the summer, I recommend a very cash-heavy portfolio. If we start to crack, I'm not going to hesitate buying puts or hitting those 3 times inverse ETFs on the long side or 3 times ETFs on the short side.